Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. This week has seen all markets turn upside down. Stocks, bond yields, and Bitcoin have all fallen. So it's a big test of investors' conviction around their core views. Through this volatility, we published on a wide range of topics, from whether it's time to buy small cap stocks, to how to trade property, to will the Chinese yuan weaken. We even have a piece on can we believe official inflation data. Members of Macro Hive have full access to all of this great analysis, our entire archive, and our Slack room, where we have healthy discussions of financial markets, which is quite different from what you see on Twitter. But if you're not a member, you can easily become one by signing up at macrohive.com. Your first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macro Hive the hidden gem for investors. So once again, sign up at macrohive.com. On to this episode's guest, I have Benn Eifert. Benn is the managing member and CIO of QVR. QVR focuses on quantitative volatility research and alternative investment strategies. He was previously co-founder and co-portfolio manager of Marino Courier in New York. Before that, he was head of quant research and derivatives trading for the Wells Fargo prop trading desk, which later became Overland Advisors. He started his career as an emerging market macroeconomist at the World Bank. He holds a PhD in economics from UC Berkeley. Now, onto my conversation with Benn. Welcome, Benn, to our podcast show. It's great to have you on.
Hey, thanks. Great to be here.
Now, Benn, if you've heard any of my other podcasts, you'll know that I always like to start my conversations with a question around your background. So currently, obviously, you're at QVR, which is an alternative strategy sort of quant fund and advisory firm, but presumably you didn't start at QVR. So what's your origin story? I mean, what did you study at university, and then what did you do after that, and how did you end up where you are now?
Sure, absolutely. So I was actually an emerging markets macroeconomist back in the day. So I was an undergraduate in economics. I went to work for the chief economist of the World Bank for a few years, working in India, Africa, a variety of places. Went back to Berkeley to do a PhD, worked with some really great folks there, decided about halfway through that academia wasn't really my bag, got interested in finance, started doing some teaching in the Master's in Financial Engineering program there at Berkeley, and through a variety of things ended up spending the last year and a half or so of graduate school mostly working full-time for a hedge fund. Then when I finished my PhD, I went to the Wells Fargo prop desk. So the Wells Fargo prop desk wasn't certainly the most famous of prop desks. People think of, Goldman and Morgan and those guys back in the day. But the important thing about the Wells desk was that through the credit crisis, I'm sure you'll remember, but Wells Fargo was one of the banks that actually was in a position of great strength, primarily owing to the fact that they weren't very smart and sophisticated and just weren't involved at all in structured credit and any of the kind of stuff that got other folks in trouble. And so while all the other prop guys around the street were getting shut down, we were able to get very strong backing from the bank and took a ton of risk and had a ton of balance sheet. And we were very aggressive all throughout financial markets. I was a quant on the desk. I was the first quant hire. I built and grew the quant team and ran it over time, and built a lot of the risk systems and analytics and so forth for the firm. The prop desk did extremely well through that period in the aftermath of the credit crisis. And then it spun out as a hedge fund called Overland Advisors. That would have been 2009, 2010. I ended up managing some of the non-traditional assets like derivatives, currency volatility, for example, in the center hedging book. And then a gentleman named John Laughlin, who would later become my partner, joined the firm. He had been a managing partner at Blue Mountain, started the Blue Mountain Equity Alternatives Fund, which was one of the really pioneering relative value derivatives trading funds in the early mid-2000s. And John and I got along really well. I went to work for him, hired a replacement to run the quant team. We built a portfolio there at Overland, and then we later left to start a firm called, or a fund called Marino Courier on the Mariner Investment Group platform. Then in 2017, I started QVR out here in San Francisco.
Oh, great. Okay. So you've seen a lot of the kind of the ups and downs in the quant or the derivative space over your career. I guess one question I would have is, the global financial crisis was a big kind of almost structural break in terms of how the industry operated. I mean, from the derivatives perspective, what types of things were kind of happening before the financial crisis? So before 2008, say over the 2000s or late 90s, 2000s, what was happening before then and what kind of changed after the financial crisis? I mean, if there was a kind of a before and after, I mean, how would you characterize it?
Yeah, absolutely. That's a good question. So there have been huge changes in derivatives markets over this period of time. And the financial crisis was, in some sense, the catalyst for the changes, but most of the big changes didn't actually happen for several years after the crisis. So I'll explain what I mean a little bit. Really, before, in the pre-08 era, think of the early 2000s, late 90s, early 2000s as being the rise of complex, structured exotics derivatives trading across the street with hedge funds and asset managers and insurance companies. And it was really a Wild West market in terms of, huge risk taking and risk tolerance among banks and among their counterparties. A tremendous and increasing amount of leverage, increasing complexity and sophistication of products, and much of which led to hidden tail risk and so forth as materialized in '08. But really, banks were very happy to trade with aggressive relative value hedge funds who could quote them out, many ways in comp, trade at mid-market all day long and almost anything that you wanted to in big size. There was a tremendous appetite for doing volume, for executing transactions. Banks really viewed that in part as just a franchise business, right? Where it wasn't just about the trade that you just got done with a hedge fund and the sales credits you booked on that or the bid offer spread you booked on that. It was also about the franchise, about growing, about being the biggest and the best, so that then the corporate business that came in saw that you were the number one equity derivatives house or the number one fixed income derivatives house, right? And they wanted to deal with you and not the others folks.
Do you think the banks at that point understood the pricing of the products they were selling? I mean, do you think they understood, or even the clients on either side? I mean, do you think people understood the complexity they were taking on, or did they kind of ignore it intentionally almost just to kind of just get volume? Or what do you think people's perceptions were of the risks of these products?
Well, I think they were very heterogeneous, right? You kind of speak as with banks as if they're kind of one mind, right? But within a bank, there are sales managers, there are risk managers, there are traders, right? And at all points in time, it's a push and pull between who has the power to get things done, right? I think that you certainly saw during the explosive period of growth, quite a lot of mismodeling, many of which there were many famous instances of that. A large Swiss bank, for example, that discovered retroactively the huge amount of losses they'd incurred, winning many trades on forward skew sensitive instruments because they were pricing complex forward skew sensitive exotics with local vol models, which you can get into a long discussion about why that doesn't work. But so there was a lot of that kind of thing. But over time, I think there were many very smart quants and many very smart risk managers that understood or had a better sense of some of the risks or complexities involved, right? But when a franchise is making money and volumes are making money, it's very difficult for the lone risk manager to move the needle at the table with the head of sales who sees those sales credits, right? That's just the nature of the beast. And then risk managers become more empowered after big losses. And that's kind of always been the cycle.
Yeah, that's a fair point. Yeah. I worked at Deutsche Bank over that period before and after the crisis. And Deutsche Bank was one of the big players in the growth of derivatives, and I could see that there as well. The sort of who had the power, was it kind of sales, was it the risk guys? And as you said, during boom times, it's more the sales and the franchise side, and then later it's more the risk guys.
Yeah, I think that's exactly right.
And in terms of examples of some products that you would sort of highlight as kind of the examples of products in that era.
Sure. I mean, so we were always more on what you would call the vanilla and light exotic side. So things like variance swaps and volatility swaps and forward starting volatility agreements. But you could get into correlation swaps and covariance swaps. And then, the exorbitant breadth and depth of structured exotics that folks would trade and that hedge funds would trade. I mean, think of at the height of the mortgage bubble, some of the most famous examples where everybody knows about CDOs and CLOs, of course, how you slice and dice credit exposures into tranches. But, you had in the relative value space, you had large famous credit funds quoting very esoteric micro tranche structures on ABS that were very explicitly sort of designed to be so complex and difficult to price that banks would have problems pricing them. And then those hedge funds would be able to get very attractive pricing from finding some bank that didn't really do it right. And so the breadth of that kind of activity and the scale of the risk was really dramatic. And then what really happened, to your point, through '08, so the credit crisis was, of course, a period of incredible stress in financial markets. And there was great illiquidity in some pockets of the credit markets, especially, right, where the deepest information asymmetry was present. What is this stuff really worth, and who's holding it and who has to sell it? But I think in hindsight, certainly from the perspective of today, one of the most surprising things about derivatives markets through '08, I think, was how relatively liquid they were and how it was actually possible to quote and trade very big size, in aggressive trades with lots of banks, even through the deepest parts of the credit crisis. And there are a variety of explanations for that. I mean, certainly one of them is that, or one slightly sarcastic one is that a lot of the traders on the desks were pretty excited about the idea of, if their seat didn't work out, getting a job at a big hedge fund. And so showing some really good prices maybe was a way of facilitating an entry to that. But in any case, you could still actually transact in big size and have a lot of banks show up to make prices in things like, equity index variance, for example. And what the thing that really broke that market environment was Dodd-Frank, Basel III, the widespread regulatory changes that really were initiated in response to the credit crisis, and where a lot of the rules initially got drafted back there in 2009, 2010, but the real implementation didn't start to bite for a few years down the road until 2013, 2014, right? When you started to see banks being subjected to a much broader array of much more precise stress tests, where you saw banks subjected to LCRs and to, wind down ratios and all sorts of much tighter regulations, much higher capital requirements. And, the traders that we would deal with, even mid-level, VP level book runners at banks who were, getting asked questions by the Fed staff sitting within the bank, looking at their slide risk down 30%. Why do you lose X amount of dollars? And this was just, totally unheard of, right, previously. And you got into an environment where banks, and this was, what the regulators' perception correctly, for the most part, right, was that '08 was a systemic crisis created by banks taking far too much risk and holding far too much inventory in complex products. And the response to that was to have banks take much less risk and act more like agents and less like principals, and use less balance sheet and have much tighter restrictions. In some sense, the regulators got what they wanted. One of the results of that was that if, when you used to be able to quote 8 or 10 banks on a particular trade, gradually only 7 of them would come back with a market, and then 5, and then it was 3, right? And the size they would come back with was half, and then it was a quarter relative to what it was before. And the spreads were twice as wide, and then they were 4 times as wide, right? And dealers would work very hard. If you came and asked for a price, they would say, okay, just give me a half an hour to check around. And they would be trying to effectively act as agency only brokers, right? To try to line up specifically the other side of the risk to do it, to back some kind of transaction, rather than being able to actually take principal risk. And that result from the perspective of a client meant that it was much harder to get the kinds of trades on that you wanted without paying a lot of spread in any kind of meaningful size, right? And I think that environment really persists today, where the liquidity in derivatives markets, it's grown overall, but where the direction in which it's moved is all away from this, complex market of banks, intermediated risk and OTC markets. It's really moved to exchanges. So you've seen huge end user growth on exchanges.
So that presumably means that the products become less complex then as well, if everything goes to exchanges or things move to exchanges.
Yeah, no, that's right. For the most part, there are periodically exchanges try to list more complex products. I mean, for example, variance swap futures have been something that SIBO has tried over and over and over again to get to stick. But for the most part, the products on exchanges are listed options, things like VIX futures, options on VIX futures. You get into options on leveraged ETFs in volatility land. That's actually a relatively complicated product, and retail trades a lot of that type of stuff, and you can raise some questions around that. But certainly, you're not trading the bespoke, complex, hybrid, path-dependent, exotic types of structures on exchange. So that market still exists in a way, but what it's really shifted to is, again, away from this two-way flow and big size between banks and hedge funds, and more into long-term risk transfer, where banks try to buy back tail risk and exotic risks that they don't want to hold from hedge funds and pension funds. And that's a little bit of kind of a toxic one-way pick-off market. And in some sense, you saw that play out very poorly last year, for example. But that's really where a lot of that the OTC volatility and derivatives trading has concentrated and away from the liquid two-way flow that you used to see in OTC and now you really see on exchange.
And so if you're a trader in this space, say on a fund side, like yourself or the people that you know, I mean, how do you build an edge in this area? Because you could imagine in the old days, because there's a lot of complexity, a lot more opacity, there'd be a perception that you can play around with more the moments of the distribution, so to speak. But now you're more constrained and things are more transparent. I mean, does that mean you have less of an edge?
I think it's a reasonable theory that complexity should come with edge. I think in practice, it's completely wrong, right? And what people tell you that they have edge in the complexity that they're doing, and what it turns out is that they're really just taking some kind of hidden, non-transparent tail risk. And either they realize it and they're not telling you, or they don't realize it, right? In a sense, right, keep in mind, vanilla options, there are, of course, exotic payoffs that you can't synthesize with listed options, but listed options fully imply the entire distribution of the joint distribution of volatility and spot, right? They're extremely flexible in terms of the types of relationships that they can create. And when you think about where does edge in the derivatives market come from in the first place, I think this is something that it's very obvious in a sense, right? But I don't hear very many people say it. People make it sound like it's all really complicated and that's where there's edge because I'm smart. That's crazy, right? Derivatives markets are very different than long-short equity, for example, right? In long-short equity, there are some stocks out there and there's this zero-sum game of smart people to figure out which ones are the right ones to be long and which ones are the right ones to be short, and you get it right and the other guy gets it wrong and you make money and they lose money, right? In derivatives markets, these markets exist because of the end user, because of the end client base, because of retail investors that are buying structured notes to get some kind of long-term payoff exposure, right? Or because of corporations that are trying to hedge their fuel price exposures or their currency risks, right? And pension funds that are trying to, customize the upside downside profile of their portfolio. And some of these organizations are more sophisticated than others, but they all share the basic premise that they're trying to achieve some kind of objective that is typically a straightforward economic objective. It's not one that's hyper focused on the arbitrage properties of second order skew of a Vole surface or something, right? Like they don't care at all about that kind of stuff, whether or not they know. They care about the payoff profile they're getting. They care about the hedge offset they're getting and getting the trade they need in the size they need when they want to do it. And they pay a large amount of transaction cost, and collectively the whole market of end users of derivatives pays a lot of market impact and transaction costs into the market to achieve their objectives, right? And that pool of transaction costs and market impact is the return opportunity set available to market makers and to secondary market participants in derivatives that have to warehouse that basis risk, that have to be there to sell the expensive thing and buy the cheap thing that's created by dislocations in derivatives markets when there are large persistent flows from end users. Right. And so the entire game is about understanding how to measure dislocations in derivatives markets that are driven by end user flow and how to capture those dislocations while managing risk appropriately. Right. It's not about somehow having a better super stochastic local vol model that has this one parameter that nobody else knows about that's kind of properly calibrated, and that's like the secret to making money, right? That's what many people would have but it's just not true.
I mean, does that then mean that you need to have a really good awareness of the supply-demand dynamics in the derivative market?
I think absolutely. That's fundamental to understanding where mispricings and dislocations come from and how to distinguish between a real dislocation and something that really is a price change, but that's driven by some underlying macro factor that's a real thing, right? I mean, for example, lots of people, if all you do is look at charts and measure z-scores, imagine going back to 2012, for example, and think of the Nikkei. Remember, Abenomics was just getting going, and the Nikkei had been on a slump for 30 years, and suddenly the Nikkei started to rally, and Nikkei skew in the equity market went inverted, right? So call vols were trading above put vols. For an equity guy, that's very weird, right? Generally, in an equity index, downside put vols trade higher, and you had a variety of people. Everyone noticed this, and you had a variety of people do things like, sell a bunch of upside calls to buy downside puts, because they said, oh, the skew is just crazy. This is some kind of mispricing, but it wasn't a mispricing, right? It was a bunch of smart macro investors buying a ton of calls because they knew that there was this huge regime change in Japanese economic policy that was about to drive a highly volatile rally in the Nikkei. And that's what happened, right? The Nikkei doubled in relatively short order on very high volatility. And if you were short calls, you just got destroyed, right? So the point is, just because some variable is at the 95th percentile or a z-score of 2 relative to history doesn't necessarily tell you that that's a dislocation caused by some price insensitive actor that's exploitable in some meaningful way, right? You need to understand what's driving dislocations. What are the supply and demand patterns? You want to be on the other side of effectively providing liquidity to the market, right? Not on the other side of smart macro investors, unless that's your game. If your game is being a smart macro investor, that's fine, right? But then you're back in zero-sum world where you're just betting against other people on whether or not you're right.
Yeah, that makes sense. And you mentioned that example of the calls being more bid than puts. We kind of have a similar dynamic today with VIX. Where VIX is kind of remaining quite elevated even as stocks are rallying. I mean, how do you see that?
Sure. I mean, VIX is, I think a lot of people correctly note that there is on average an inverse relationship between implied vol and stocks, and infer from that somehow at all-time highs in stocks you have to be at all-time lows in vol. Right, which is not true at all, right? Volatility is the second moment of the distribution, right? If you're having a relatively volatile rally, or a rally that is bringing with it a lot of downside risk, then people are buyers of options, and then volatility can remain elevated over extreme historical lows. And that's perfectly natural, right? I mean, we're in a world right now where every month there's a new 5 or 10 standard deviation event somewhere in markets. Underlying liquidity conditions are super fragile. There's huge retail buying inflows in short dated options all over the place. You've got, companies like GME doubling or getting cut in half every day. This is not a VIX 12 environment, right? This is a VIX 20 environment. And will VIX eventually one day go back to 15 or 14? Sure, but not in this market environment.
Yeah. And you mentioned retail trading. I mean, is that a more recent phenomenon over the past few years, or has that been something that's been going on for longer, over the last, say, 10 years?
No, so that's a very recent phenomenon. Really, the origins of the big upswing in retail trading and options trading in particular date to later 2019. You can really see it in the data when you look at small trader account option volumes, when you look at account openings across all the major retail platforms, Schwab and TD and so forth. You see a significant uptick starting in mid to late 2019. Late 2019 is actually when a lot of the competing brokerages moved to a zero commission model. And so Robinhood was the one that a lot of people focused on, but many of the other brokerages moved to match that, right? And that certainly accelerated. I don't know if it was the original cause. I think there's probably a variety of causes, right? But that really amplified this trend of rapid growth of retail trading and retail volumes. Then when the COVID crisis hit in early 2020, you had a lot of people sitting at home, unsupervised, able to trade on their personal computer while they were doing work, or maybe they were unemployed and had lots of time anyway. And I think that also, again, dramatically amplified that trend. And what you've seen is just parabolic growth of retail trading across the board, most notably in options, and especially in short-dated options. So if you were to look at call option volumes among small trader accounts, they're up 10 times versus prevailing levels 3 years back, for example. And a lot of that is in extremely risky types of trades, things like buying far out of the money 1 week options, where the default outcome is just that you lose all your money, right? Because the stock doesn't go up 30% or something like that. So this is a huge trend in option markets. It's something that I think a lot of investors didn't pay much attention to until very recently, especially the GME episode in January. But volatility and options managers had been paying attention for a while because these flows are huge relative to, right? You get a lot of people, I think, who very naively say, oh, retail can't possibly be, retail's unimportant, retail's small, retail doesn't have that much money. Retail option trading volumes are astronomical, right? And, because you're talking about collectively many, many millions of people, many of whom there's a stereotype that it's college kids with, $500 in their account. I'm sure there's some of that, but it's not. It's all of the 20-something-year-old professionals in, the United States, right? Talk to your law firm or talk to your accounting firm. All, the VP level 28-year-old kids all have Robinhood accounts and they're all trading options.
Yeah. And what's the implication of that retail trading then? Does it mean that the short-dated vol surface gets heavily impacted by these retail guys, that, the opportunity you have to focus on then?
So it does definitely affect the short-dated volatility surface a lot. And yes, it's a good area to focus. It's, I think, like many things in derivatives markets, it's more complicated than just, so retail is buying something, so you're supposed to sell it. That's not always right. The world doesn't always work that way. One implication, right, of very heavy short-term option buying particularly on smaller single names, right, is that the other side of that position is going to sit with dealers and market makers, right? So dealers and market makers are going to be short a lot of gamma, right? Short a lot of convexity. They're dynamically hedging those positions. When, if you take a stock like GME, for example, where retail buys a ton of next Friday, 40% out of the money, 30% of the money calls, and GME is going up. So first of all, the leverage that retail gets in those products are very high, right? Because instead of buying a share of the stock, you can just buy a call option, and it might have a 10 delta, but it might only cost 40 basis points or something, right? So you're getting humongous leverage. And then second of all, as that stock rallies, that delta is going from 10 to 20 to 30 to 50. And the market makers and the dealers are buying and buying and buying to maintain their hedges, right? And so that dealer gamma implication, right, where big short-term call option buying creates amplified realized volatility in the direction of the strikes and the direction of the buying is very powerful, right? And so you can get run over real quick if you look and you say, that vol just went from 30 to 35 on retail buying, so I have to sell a lot of it. You need to be real careful.
Yeah, of course. Yeah. I guess the gamma profile of the market then kind of goes against you if you're trying to short it in that scenario. And, just kind of more for a philosophical question here, one of the very sort of common strategies people have, and I guess this is also, I suppose, linked to some of these flows, is to systematically sell vol. So you mentioned earlier, there's lots of, these structured notes. And implicitly, what many of these types of strategies and products do is they're just implicitly short vol, to kind of capture the risk premium. I mean, do you think just fundamentally, vol selling strategies should kind of work over time, or do you think it gets arbitraged away, or do you think that it depends what part of the curve you look at, so it's further out the curve now than before? How do you think about short vol strategies?
Sure. So I think the first important thing is that short vol is a tremendously broad word, right? There's a million different types of things that are one way or another short vol, and they're all very different. If you were to take just the example of the most popular types of things that are relatively safe in a sense, so they're not focused on selling extreme crash risk, but things like call overwriting strategies or iron condor selling strategies, shorter term, more limited loss type of option selling strategies. So those are designed primarily to capture in some way or to benefit from the volatility risk premium, usually in the shorter dated part of the curve. So that risk premium was relatively high for a long period of time. A lot of folks really noticed that and consultants started to write white papers about it and suggest call overwriting and cash secured put selling to pension funds. By 2013, 2014, you saw huge inflows into those kind of strategies, and that risk premium started shrinking, and it eventually shrunk to around zero before the COVID crash. Then, of course, there was the COVID crash, and that generated strong negative performance for a lot of those strategies. Now I think the jury's out. I mean, volatility risk premium has been realizing fairly consistently again since the COVID crash as volatilities come down. The jury's out on where things will stabilize. But to your question, they're in equilibrium in the long run in some sense. There absolutely should be a volatility risk premium because, like there should be an equity risk premium, you should get paid for taking risk. And if you're earning no return, taking a lot of risk, doing something for a long enough period of time, they're going to underperform, and eventually some money is going to flow out of that and so forth. So over the long run, there has been a volatility risk premium, and in general, you should expect there to be one. It's a different question when you look at strategies that are extremely levered into the tails, so selling variance or selling options on variance, these kind of things. So it's harder to tell because there your statistics in some sense are all about how many, okay, there have been 3 crashes or 4 crashes over X period of time, and how much did you make versus how much did you lose? And you're not really getting a very good, what is the probability of it 100% realized of all month? Well, we had one in March. What's the probability of 200% or 300%? And none of us know, right? It's some small probability, but everything depends on whether it's 0.1% or 0.01%. And nothing about the world lends itself to knowing the answer to that question.
Yeah, that's true. And then in terms of you mentioned, some structures, you talk about the convexity. Do you think people don't appreciate the convexity risk they're taking in lots of the structures they have on?
Yeah, I think that people don't always necessarily think through the nature of how their risk in their portfolio will evolve as things happen. And that's essentially the same thing. So, and it's related to the point about the difference between simple vanilla risk contained strategies like I was talking about and variance selling. But for example, the reason that variance swaps are popular mostly tends to be the perception that they're simple and that they're this very clean volatility exposure, right? Where you have a variance swap, you sell it at 20, at least to a first order approximation. If it realizes 19, you make $1. If you sold it at 20, time 1 times your Vega notional, and it's strikeless. And those things are all nice. But the important thing about a variance swap, the main feature, is that if volatility doubles, then your volatility exposure on your position doubles. And if volatility expands by 4 times, your exposure expands by 4 times, right? If you're short that convexity, that's a very horrible risk property of a position, right? Because when you're losing a bunch of money, your risk grows, and that kind of happens without bound. And so you had folks in March, for example, who didn't think of it as selling tails, who had a lot of spread trades in variance, where they were long, for example, Euro stocks variance and short S&P variance, or long Nikkei variance and short S&P variance. And they said, heck, this is a hedged relative value trade, right? I'm not short tails. I got a long, I got a short, it's Vega neutral. But if you have a long and a short in variance, again, the same thing is true, right? Where that position, the risk of that position grows without bound as volatility moves higher. And if it's moving against you, it's moving against you catastrophically, right? Whereas if you had that same position on just in listed options or even in volatility swaps, which is the less nuclear cousin of the variance swap, you're in much better shape. That's right. You're in much better shape.
Yeah. And so, from your perspective, then, do you put tail risk strategies or convexity strategies on? Is for like a profitable strategy, or do you think about it more in terms of how to think about the risk of your portfolio or your clients' portfolios?
Yeah, it depends on the problem that you're solving, right? We run absolute return hedge fund strategies, and we also run bespoke tail risk mandates for investors, right? And those are 2 very different things. The way to think about a tail risk mandate is very much in a portfolio or an overall asset allocation context, right? It's not a standalone strategy. The point is you have an investor who is a big asset owner who owns $10 billion worth of equities or whatever it is, right? And the problem they're trying to solve is the long-term growth of their overall capital base. And one really important thing about convexity and tail risk is that you can have a defensive, long convexity, long tail strategy that loses money on average over time on its own. But if added into an asset allocation where there's rebalancing every month or every quarter or whatever it is in a standard way between the hedge and the underlying portfolio, right? Where if the market's rallying, the investor's making money on their equities, they're losing money on their hedge. But then if there's a crash, they make a ton of money on their hedge and they're losing a bunch of money on their equities. What that rebalancing allows, right, is to suffer much smaller drawdowns in that market crash, to have a lot of cash buying power for distressed assets down there at the bottom, right? And then the opposite kind of during rallying periods. And you can end up not just with a lower risk profile of the other overall portfolio, but with a higher compound growth rate of the overall portfolio because of the complementarity of that. Making a lot of money in a negatively correlated way in the worst environment, right, is very powerful for the overall portfolio.
And what's an example of a hedge there? Like, so if you imagine, a pension fund with a roughly 60-40 portfolio, say, in kind of that context, what would a typical hedge look like?
Sure. I mean, you could just think of 6 to 12 month 20 delta put options, for example, delta hedge strike. Generally, for hedge portfolios, one doesn't want to get overly complicated, but one wants a simple, liquid, and really cost-efficient way of hedging. It tends to be somewhat further out the term structure, just because usually very short-term options with a lot of decay are a better match for more dynamic strategies or for someone who has a tactical view or something, right? But something like that that's relatively low bleed, that tends to lose money over time, but makes a lot of money right at the worst time for the rest of your an asset owner's portfolio, right? It's the key thing is the interplay between the core portfolio and the hedge and rebalancing between the two.
Yeah, okay, understood. And so, this is kind of the hedge kind of scenario, and then the alternative scenario of when you're running like absolute return fund. How do you think about some of these types of strategies?
Yeah. So in an absolute return strategy, the objective is for the overall strategy to make money over time in an uncorrelated way, not to have an interplay with another portfolio and this kind of rebalancing dynamic, right? So there's a couple of ways that an absolute return trade can potentially perform on a forward-looking basis, right? There are symmetric types of opportunities where there's a hedged long-short type of position or strategy that has a relatively symmetric distribution, and the mean of that distribution and the median of that distribution is positive, and that's fine. But you can also have significantly positive expected return trades that are a 90% chance of being flat or a 99% chance of being flat and a 1% chance of making a whole bunch of money in some crazy event, right? Essentially a very cheap or free option. And certainly, I think culturally, a lot of the types of people who liked buying cheap options, weren't around anymore by the time that March hit. Unfortunately, just culturally, I think you had this big shift towards more short vol strategies. But for us, we're certainly happy if we find, in an absolute return context, if we find trades that look to us like they might offer that kind of profile, very low expected cost or no expected cost for a potential asymmetric win. Those are great opportunities, and one can put them in the portfolio and not worry about them too much. And then if the appropriate event hits and they work out, then that's great, right? And that particular scenario in which they might pay out might be a market crash, for example, but there isn't the same logic as there would be behind an explicit tail risk strategy where you have this long equity portfolio or this long risk assets portfolio, and you're trying to complement it in a very explicit way.
Yeah, understood. And, in terms of, the clients that you speak to, you advise and so on, say over the past 6 to 12 months, I mean, what are the kind of the biggest challenges or questions they come up with?
Absolutely. So I think that it's been quite an evolution in the last year, right? Because immediately after COVID, there was this incredible market drawdown. And then, if anything, I think you saw the greatest desire among clients just to plow money into a lot of the types of assets that had gotten heavily beaten down, right? And while folks were hurting, they also, I think, weren't too conflicted about what the right thing was to do, right? They were buying credit, they were buying equity, they were investing with hedge funds that had been closed for a long time that temporarily opened up. There were a lot of opportunities out there that people saw. Once you get to this point, now we're sitting here with the S&P nearly 4,000. I think that the common perception that a lot of asset owners have is beta has rebounded much better than they could have ever imagined. They've lost most of the perceived diversification benefit of fixed income in their portfolios. Now you can argue, okay, rates have moved higher this last month, and you can get into some arguments about, okay, at what point is the 10-year a better diversifier again? Certainly at 160 basis points, it looks a lot better than it did at 60. But you have a very common notion, right, that 60-40 portfolio and a lot of the diversification benefits you got in the offset between the 60 and the 40 with rates at zero and long-term yields near zero, that just didn't make sense, right? So a lot of the questions people had were, what do I do with my fixed income allocation? How do I get uncorrelated return streams? And how do I get offset to my equity portfolios, and that I think has been a very common theme.
Yeah. And I mean, do you have a view on whether fixed income is, an adequate hedge at kind of at the asset level or not?
Well, I think everything depends on price, right? I think that at 50 or 60 basis points on the 10-year, you had to make a very tough argument to think that there was a lot of diversification, right? You could argue, okay, yields could go if we had a big shock here, yields could go very meaningfully negative. We could go to negative 50 basis points. And, you can tell that story and you can argue that point. It's tough. It's a tough one, right? From here, we've backed up 100 basis points plus in yields. 1.7% still pretty low, especially with the economy looking like it's going to grow pretty strongly. But yeah, at some point in this range, you still look globally, right, at where yields are. The appetite for U.S. fixed income is pretty strong from Europe and from Asia. That'll probably continue. And in some sense, if you're starting at 160 or 170 basis points, every 20 basis points you back up, think about all the incremental demand from those investors that didn't really like bonds at 60 basis points, but at 200 basis points, that 10-year looks pretty good as a diversifier, right? So I think that the narrative around is fixed income, should it be a part of my portfolio at all, I think that will start to fade as yields keep pushing higher from here.
Yeah. And then do you like to think about all of these big themes that people are discussing these days? Could we get acceleration of inflation? Stocks are overvalued. I mean, first, do you take views on these sorts of things? And secondly, do you think it's useful to take views on these things?
So there are certainly people who make their living out of taking those kind of views. We think it's important. We think it's much more important to understand those narratives in the marketplace and understand who shares those narratives, how dominant they are, and what the positioning around those narratives is, and how that's going to affect how markets might behave in different scenarios, than it is to form those views or have your own know where you are in that camp. That's, we think, at least in the types of things that we're involved in, again, it's really dislocations between related variables and related products. It's really flows and positioning that drives a lot of the opportunity set. It's not, is inflation going to be 2.7% or 2.4% or 1.8% over the next 10 years? Now, that certainly matters a lot for asset owners' portfolios, and we work on the solution side of the business and tail risk hedging and so forth. We certainly work with folks to think through those questions in terms of portfolio implications and how to structure hedges, but we don't make our living on establishing that view of whether 2.8 or 2.4 or 1.8 is going to be the number.
Yeah, understood. And on the flows and positioning side, the information you use there, is it generally publicly available information, or do you have access to some data sets that other people don't have access to?
It's generally a combination. I mean, some things. So, for example, if you want to see the positioning of investors in VIX exchange traded products in terms of what kinds of volatility exposures they have on by using those products, that's publicly available and you can work that stuff out for yourself. But there's a lot of things that are in the middle, right? So certainly you can understand things like when you think about a lot of the risk of sharp moves suddenly in the marketplace, they usually come from some combination of hedge fund, of levered money being excessively net long and excessively grossed up, interacting with option market microstructure where dealers are relatively short gamma. And a lot of those things, the various pieces of information are accessible to different investors one way or another. And the question is, how do you put all those pieces together in a consistent framework? And that's not a trivial thing.
Yeah. But I used to work with Charlie McGilligan at Nomura, and I actually had him as a podcast guest, and he tends to track lots of these things quite well. I'm not sure if you follow some of his work.
Yeah, and more importantly, his incredible mustache.
Yeah, it's quite an impressive mustache and beard. Yeah, and it keeps growing every time I see him. Yeah. And I mean, while we're kind of talking about more personal things, I always like to ask my guests not about their facial hair, but rather about their other habits. You obviously do a lot of research. You look at markets in lots of different and interesting ways. How do you kind of manage your research and information flow? It's quite easy to get overwhelmed. There's a lot of noise out there. I mean, how do you sort of manage this?
It's a good question. So We at QVR are very process driven and internally driven. So on the absolute return side, we have a variety of specific strategy themes that all have a significant research base behind them, and where the continued research is incremental, is improving something, is getting a new piece of data that would fit within the framework. And then we have a pipeline of new strategy R&D, but it's much more like, a large project that you've effectively been working on for 15 years and are pushing to, a little piece further, one bit at a time. And there being a collection of those things in a very structured process and workflow around that, as opposed to, the thing where you come in every morning and try to look around and see what's interesting and, look for an email that gives you a hint to go look at, your Bloomberg or something like that. Right. So we're, much more in the systematic camp. And of course there are things that get you started on some new idea, but I think people overestimate the importance of the kind of blue sky imagination thing where you sit down in your chair and you have this light bulb go off and come to some truly unique insight, as opposed to really the kind of the blocking and tackling and the carpentry of excellence across the broad pipeline of what you're doing.
Yeah, absolutely. I've always kind of found that as well. I mean, the waiting for inspiration, it just never seems to happen with me for some reason. So I just have to kind of plow away at the day to day, and then therein all the ideas that come out at that time. But have you always been that? Have you always worked in that kind of process approach? Is that just part of your personality, or is that something you've learned over time?
Yeah, so it's certainly been an evolution. We have essentially been running a very similar investment process for a very long time. When I started my career, in some sense, by definition, when you're young, you're much more either on an existing team where you're working with a boss and following his instructions and learning, or in my case, a little bit more, you're sitting on a desk and you're the quant and you're working with senior portfolio managers and traders who have ideas and have things they want to do, and you're very responsive to those ideas, right? And you're working with them to try to think of how can you capture that idea, how can you build it into software in the way that someone's explaining it, and so forth. And so it's less about independent research and just coming up with new ideas as it is about understanding the world better, working with really smart people like the folks that I grew up with at Wells Fargo Prop to understand markets the way that they do and to capture what they're thinking about in logic and in math and in code and so forth, right? And so over time, you really build that capacity to do independent research and build a process for yourself and so forth. But I think you inevitably don't start there.
Actually, that kind of brings up a question in my mind is, what do you think the most common mistakes are that people in the quant space or, the derivative space make?
Great question. I think that first of all, over complexifying things is a innate problem that a lot of more junior folks have. Related to that is trying to pursue the direction of very sophisticated, very complex, structured models that are used for exotic derivatives pricing or that appear in academic literature, when in some cases there are uses for those things, but they tend to be very specific and very narrow. And usually at banks on an exotics desk, that process is managed pretty well. But when a more junior quant sits down outside of that kind of environment and they're thinking, okay, where am I going to find an edge in option pricing? I know I'm going to try to calibrate the newest, fanciest, crazy model. That's not where edge comes from. Again, I think really focusing very heavily when you're junior in your career on learning from people who have been in the business for a long time and understanding how you can use the skills that you have to attack the real problems that people have in this business. I think that's really the key.
Yeah, that makes sense. Yeah, absolutely. It's funny, when I look back at my career early on, I definitely was in thrall of complexity and just using the latest quant techniques. And then as the years have gone on, I use less and less and less. And everything's becoming simpler and simpler and simpler. It's kind of an inverse, relationship with my years of experience.
Yeah, exactly. And I think luckily it's the direction the opportunity set has gone in derivatives markets as well, in my view.
Yeah. And the other question I wanted to ask was on books. I love reading books. I always like to get recommendations from other people, but have there been any books that really influenced you over your career, or books recently that you've read that you really have enjoyed?
Oh gosh. I mean, there are many, many great books that I've read in life. I would say that I read one that I really enjoy that crosses personal and work was The House of Morgan, which is about the Morgan Stanley and JP Morgan empire from its origins, but is really a book about the history of financial markets globally and the development of international trade and facilitation of that trade by banks and the formation of the modern global financial system. It's I think a really fantastic. I think it's the kind of thing that it's very difficult for people to understand how a lot of these things work when they just sit down at their computers and get their Bloomberg and read their sell side emails and so forth without having a rooting in that type of detail around where central banks came from and how financial crises used to look back when we just had a bunch of banks and JP Morgan used to get into a room with 20 guys and try to figure out what they were going to do to bail out the brokers and all this type of stuff. So I think that's a fantastic book.
Yeah, that's a good book. I read it years and years ago. I started off my career at JP Morgan, and so it was part of the training program where they kind of recommended that you read that book. Although not many people did, I did, but it's definitely in some ways, JP Morgan, his life was, is kind of I guess he was almost like the equivalent of a Fed chair in his day. So you definitely sort of get that feeling when you read that period of history. Okay, that's excellent. Now, before we wrap up the conversation, if people wanted to follow your work in some way, the work you do or QVR does, what's the best way they can follow your work? And if they wanted to reach out to you, what's the best way they can do that?
Sure. So it depends on what their angle is. I think for folks interested in casually following some of the kinds of ideas that come up in volatility and derivatives, in my Twitter feed, occasionally I get into things like that. You can look me up at Benn P. Eifert on Twitter, but also you can go to our website at qvradvisors.com. There's contact information there.
Okay, that's excellent. Okay, well, yeah, that was a really excellent sort of conversation. I learned a lot as usual whenever we speak. And good luck with everything for the balance of this year, Ben.
Hey, thanks a lot, Bilal.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and comment and let other people know about the show. Also, sign up to become a member of macrohive.com. We'll be back soon, so tune in then.